Ethereum staking has created the largest yield-bearing digital asset market in history. Over 34 million ETH, worth more than $120 billion at current prices, is staked in the Ethereum validator network, earning approximately 3.5 to 4.5% annualized protocol yield. For context, 10-year US Treasury yields sit around 4.3%. Ethereum staking yield is comparable to sovereign debt yield, but it carries fundamentally different risk. Unlike Treasury bonds, staking yield comes from protocol inflation and network fees, is denominated in ETH, and exposes the staker to slashing risk, smart contract risk, and withdrawal queue liquidity constraints. For institutional fixed income allocators considering yield-generating digital asset strategies, the staking economy represents a genuinely novel asset class that demands a purpose-built analytical framework. This video builds that framework from first principles. Ethereum staking yield has three components. The first is consensus layer rewards, issued by the protocol to validators who correctly attest to blocks. These are predictable and scale inversely with the total amount of ETH staked. More stakers means lower yield per staker, as rewards are split across a larger validator set. The second component is execution layer fees, the priority fees paid by users who want their transactions processed quickly. These are variable and increase during periods of high network activity. The third and most controversial component is MEV, maximal extractable value, the profit validators can earn by ordering transactions strategically within blocks to capture arbitrage opportunities or liquidation bonuses. MEV-boosted validator returns by 0.5 to 1.5 percentage points above base protocol yield in 2024. Together, these three components determine actual staking APY, which varies from 3.5% in quiet markets to 6 to 7% during peak activity periods. The scale of the Ethereum staking economy in 2026 provides important context for institutional sizing decisions. Total ETH staked exceeds 34 million, approximately 28% of all ETH supply. Over 900,000 active validator nodes are registered on the network. Lido Finance is the dominant liquid staking protocol, controlling approximately 32% of all staked ETH with 11 million ETH. Rocket Pool operates a more decentralized model with approximately 800,000 ETH. Coinbase's CBETH has over 2 million ETH from institutional clients. The annualized protocol yield as of Q1 2026 is approximately 3.8% for consensus rewards alone. Adding MEV boost participation raises effective yield to approximately 4.5% for most validators. The withdrawal queue, the time required to exit a validator position, averages 2 to 5 days in normal conditions but can extend to several weeks during periods of high exit demand. Institutions accessing Ethereum staking yield have three primary pathways with distinct risk-return profiles. Native validator operation, running a 32 ETH validator node independently, provides maximum yield and zero counterparty risk but requires 24/7 operational infrastructure and carries full slashing exposure. Managed staking through institutional custodians like Coinbase Prime or BitGo provides similar yield with operational risk transferred to the custodian for a service fee, but introduces counterparty dependency. Liquid staking through protocols like Lido provides staked ETH receipt tokens that can be deployed elsewhere in DoFi, maximizing capital efficiency, but introduces smart contract risk and validator operator concentration risk from Lido's dominant market position. The yield differential between these pathways is small, perhaps 0.2 to 0.5 percentage points, making risk architecture the primary differentiator for institutional selection. Ethereum staking carries a layered risk architecture that institutions must evaluate holistically. Slashing risk is the protocol-level mechanism that destroys a portion of staked ETH if a validator commits a slashable offense, double signing or equivocation. For managed staking providers, institutions must verify slashing indemnification policies explicitly before delegating validator keys. Liquid staking smart contract risk is distinct. Lido's contracts have been audited multiple times but remain immutable, a bug that past all audits could still be exploited. Staking yield is also denominated in ETH, not USD, so the real purchasing power of staking income depends on ETH price performance. An investor earning 4% ETH yield while ETH falls 50% has experienced a significant net loss in fiat terms. EigenLayer's rest-taking protocol, launched in 2024, created a new layer of the Ethereum yield economy that institutional allocators must now understand. Rest-taking allows holders of staked ETH, including Lido's SDETH, to additionally secure external protocols called actively validated services, or AVSs, earning additional yield on top of base Ethereum staking rewards. EigenLayer grew to over $15 billion in total value locked within its first year, making it one of the fastest-growing DeFi protocols in history. The institutional implication is significant. Rest taking creates a yield stack where the base Ethereum staking yield of 3.5 to 4.5% can be supplemented with rest taking rewards, potentially pushing total yield to 6 to 8%. But it does so by layering additional slashing risk. Rest acres can be slashed by both Ethereum consensus rules and by the AVS they are securing. The compound risk structure requires careful institutional risk assessment before deployment. Institutions building an Ethereum staking yield strategy should follow a four-step framework that balances yield optimization with risk management. Step 1 is yield source mapping. Decompose the target yield into its components: consensus rewards, MEV participation, and any rest-taking layer. Each source carries distinct risk and requires separate policy approval. Step 2 is pathway selection. Choose between native, managed, or liquid staking based on the institution's operational capability, custody architecture, and liquidity requirements. Step 3 is slashing indemnification verification. Before deploying any capital through a managed provider, obtain written confirmation of slashing indemnification terms, coverage limits, and claims procedures. Step 4 is withdrawal liquidity modeling. Build a detailed model of withdrawal queue timing under normal and stress conditions and confirm that the modeled liquidity timeline is compatible with the institution's redemption obligations. 3 staking mistakes consistently appear in institutional yield programs. First, treating staking yield as analogous to bond coupon income without accounting for ETH price-denominated returns. The yield is in ETH, not USD, and the total return depends heavily on asset price performance. Second, overlarking capital in native validators without modeling withdrawal queue timing. Institutions with quarterly redemption obligations cannot afford 2 to 5 week withdrawal delays in stress scenarios. Third, deploying rest-taking without understanding compounded slashing risk. The additional yield from rest-taking comes with additional slashing exposure that is additive to, not separate from, base staking risk. The Ethereum staking economy offers institutional-grade yield at a scale that is now genuinely comparable to sovereign debt markets. But the risk architecture is fundamentally different from fixed income. The yield is ETH denominated, carries slashing and smart contract risks, and is subject to withdrawal queue constraints. Institutions that build purpose-built staking risk frameworks will extract durable value. Institutions that apply fixed income frameworks without modification will be caught off guard. Ethereum staking has created a yield economy that rivals sovereign debt in scale, but requires a purpose-built institutional framework to navigate safely. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.